A venture capitalist's job is to look over the horizon and reach for high risk, huge reward possibilities that most people consider unattainable. This is what Sebastian Mallaby writes in his book, The Power Law: Venture Capital and the Art of Disruption. It is about wagering on the idea of big leaps, like VCs have done in the past, by backing upstarts like YouTube and Tesla in early days, which disrupted well-established industries. In India, early bets on loss-making tech startups have birthed multi-billion-dollar profitable companies like Zomato. But such outcomes, as our guest pointed out, have been few. So of late, VC firms have been emulating their more conservative PE peers. They are now diversifying their portfolios and moving beyond tech startups to include more traditional sectors. I mean safer investments in non-tech firms. Think luggage brand Mokubara and jewelry retailer Bluestone. After the windfall capital inflow in 2021 into startups, growth at any cost is no longer appealing to VCs. Instead, their focus has shifted to backing startups that are either already profitable or have a clear path to it. What's behind this flip? Is it typical to every funding winter, or is something fundamentally shifting about venture investing in India? Are venture firms making peace with the scenario of modest returns instead of losing money on multiple ventures, hoping for a grand slam outcome?
Venture capital firms have to think about how long do we have to wait for India to have many more outcomes of that size on a consistent basis? Should we have every year one company which crosses $10 billion of value?
It's sort of coming back to full circle that the pace of innovation, both for India 1 and India 2, has slowed down. There is a concern about whether we can keep investing in game changers. I think the camp is divided, but I think there is hope.
The classic dilemma right now is that if everyone starts backing, say, businesses like, say, coffee, omni-channel, whether it's retail, fashion, beauty, whatever, the tech first bets that happen, like the growth, the exponential growth that you can take, that will not happen.
In today's episode, I speak to Abhay Pandey, who's the general partner at A91 Partners, which has backed consumer startups like Attenberg and Sugar, early stage investor Anand Lunia, whose fund India Quotient has backed companies like ShareChat, and our in-house startup and VC expert Digvijay Mishra. It's Friday, 28 June. I'm your host Apurva Mittal, and you're listening to Rethinking Risk, the new strategy of Indian VCs, only on the Morning Brief. A lot has been unfolding in the VC world over the past 2 years. Brand Sequoia left India last year after almost 2 decades of operating. AlphaWave, another major investor in India, shifted its focus away from tech and tech-enabled businesses into traditional ventures. And investors like SoftBank and Tiger Global have largely been absent. There have also been some high-profile exits of senior partners from VC funds in India. Among other factors, Indian startups' ability to generate meaningful returns has been under question. So it isn't surprising when Nexus Venture partner MD Sameer Bridge Verma departed the fund to start his own multi-stage fund, which is not looking at a multi-billion-dollar outcome, as my colleague at ET had earlier reported. But it is not all gloomy. Last week, General Catalyst announced its merger with local outfit Venture Highway to double down on India. I spoke to Abhay Pandey of A91 Partners to make sense of venture investing in India. His fund has been actually making both tech and non-tech bets since it started in 2018. I started by asking him if VCs in India are having an existential crisis.
That's a big, tough question. No, I don't think they're having an existential question, but many are being forced to think about how to rethink their business, if you will. And rethinking has many components. It's about how you operate in the market, what's the size of the market that they're addressing, what are the strategies they want to follow for the real venture market in India, and so on and so forth. How do they start thinking about multiples and valuations and exit, some of the things that they thought very differently versus what you're being forced to think again, given how the market has dramatically changed over the last 2 to 3 years.
Can you talk about some of the main themes around this rethink and what's that sort of leading to?
So, if you go back to the venture capital business model, what started in the US in the late 60s, early 70s, then went on to China, Israel, India, the basic essence of the venture capital business was you need large domestic markets and you need a lot of engineers. It worked extremely well in the US. It worked very well in China. In Israel, there was a little bit of an issue because the large domestic market did not exist, and therefore most of the Israeli companies and startups were building for the US market. In India, the venture market started in the early 2000s, and people were waiting patiently for a large market to come. And reality is, after 25 years of the venture capital market in India, we've had two outcomes which are more than $10 billion, Flipkart and Zomato. There are others that have threatened to get there and have come back and so on and so forth, but let's keep them aside. A large and successful venture capital market depends on super large outcomes, the power law as we call it. And if there are only two such large outcomes in 25 years, and there are 50 and 100 firms fighting for the same two outcomes, it's not going to work as well as it's worked in China and the US, where the number of such large outcomes is very many. Venture capital firms have to think about how long do we have to wait for India to have many more outcomes of that size on a consistent basis. Should we have every year one company which crosses $10 billion of value? That still seems somewhat far away. And therefore, in the meantime, you have an option of saying, I will either work with a much smaller fund size, because while we're not getting $10 billion plus outcomes, we're getting many billion-dollar outcomes. We have many companies within the $1 to $5 billion outcome. And if you can get 10% of those companies post dilution and everything else, it still does extremely well for a smallish fund. And that fund size, based on our estimates, is somewhere in the $200 to $300 million. That's the largest venture capital fund you can have in India to have reasonable outcomes. That doesn't guarantee it, but it improves your chances of having reasonable returns. But for a variety of reasons, venture fund sizes have gone up to 500 to even $1 billion. And it's very hard to, in the Indian context, deliver very high returns with those size of funds. Compare that to the US. Even some of the best venture capital firms in the US, even after many years of existence, in a much productive, fertile market, have still kept their fund sizes in the 500 range. And in India, we are doing the same and going beyond that in a much less fertile market right now. So the choice is to really say, I will either become much smaller in size, or I will have a slightly different strategy where I'll do pure venture and I'll do a little bit of growth as well from the same fund, which is where most of the venture funds are beginning to go, which is a single fund which does both venture investing as well as some growth investing, which has other implications in terms of fund returns and so on and so forth. It's a business question. It's a question that the fund managers as well as their LPs have to answer together as to what makes sense. But that's the call people are taking for now.
So the type of investments they're making, has that also changed, which is what we're seeing in some of the more traditional offline-led investments that are happening right now?
To an extent, yes. If you look closely, the number of pure tech investments where you think the opportunity and the size of the opportunity is extremely high have been limited, which is the number 2 out of many thousands investments in 25 years. And if you extend that to 1 billion plus, that number might go up to 100-ish or so. That's still small in the context of the number of funds that we have. The reality is, in India, a large part of the market is offline. And most of the businesses are being offline, depending on which sector, which type of business are we talking about. 50% to 90% of the market may be offline. And if you have to address that, you have to go to offline-led business models. These models also tend to oftentimes have better economics if played well. If you look at the unit economics or the channel economics of different companies across offline and online. Now, this data is evident and obvious to all the venture investors. They're looking at it and then saying, hey, what's wrong in going after a pure offline business model? We can make reasonable returns here as well. It's just not the traditional way of how venture thought about it. And therefore, it looks odd from our lens. But if you think from the point of view of saying, can we make money here? And that's all we are all here to do, then it's okay. Also, venture firms have been doing this for a very long time, but the proportion of that was much lesser. over the last 2 3 years, post some of the reset that's happened in 22, that number is beginning, a percentage is beginning to increase. And therefore, from an outsider's lens, you feel like, hey, what are these guys doing? They're doing a little bit of what they did earlier on the offline side because it's beginning to make sense for everyone.
So, Abhi, how have the expectations changed regarding the kind of returns that Indian startups can deliver? Have the expectations of your limited partners or sponsors changed at all in the last 2 to 3 years?
I think expectations are still the same. So let's put some perspective to what do LPs expect. When LP invest in a venture fund, they would love if the fund can deliver 30% net dollar IRR.
Hmm.
They'll be happy if you deliver 25% net dollar IRR, and they'll be okay. They can live with a 20% net dollar IRR. But if you start going under that in a venture fund, LPs start getting disappointed. And take that to a growth fund, the same numbers would be, I would be very happy if you delivered 25. I'll be happy with 20, and I can live with 15. So about give or take 500 basis points lower for growth versus venture because you're taking extra risk in venture. Now, over the years, venture funds as a basket has not delivered that along those lines, and therefore LPs have been disappointed. But there's always the expectation that the future will be different, and India's time is beginning to come, and therefore LPs will still expect the same return, and therefore both GPs and LPs will expect that they're closer to the expectations of LP returns. Only time will tell whether we match it or not. But if LPs start lowering the return expectations, then they'll say, why bother with India? If we can't make these returns, yeah, then why invest here? The US markets are giving you similar returns. Why not stay close to home? So I think the expectation is still the same. They're marrying those expectations to some reality and saying, hey, past has been disappointing, but let's look ahead. We see promise. We see that things are improving, and our venture managers are a lot more experienced and will hopefully deliver better.
Abhi, this move to traditional investing for other venture funds, which were heavily into tech investments, do you think this is a temporary theme or something that will go on for a few years?
I think in the short term, it will be, or medium term, it will continue. So let's go back to what the core of a venture firm is. The core is to find disruptive ideas that can scale up very rapidly and create large companies. This depends on a large domestic market. In this domestic market, your product or service will be tested. You do well, you get some economies of scale, and then you start going overseas and capture a large part of the market around the world. This is how companies in the US and China have done. In India, the domestic market has not been large enough, and the market has been open. So when you're in an open market, it gives a chance to all the large companies, like Google or Facebook or Microsoft, to come and dominate those pockets in the Indian market, while there was no company in India which had the chance to experiment their product service in the Indian market and take it outside. But fast forward many years later, and that many years later could be 10 or 15 years later, we'll find Indian companies that have a large domestic market where they experiment and create a successful product and service, and then they're able to export that. But till that happens, and that is required for a continuous creation of large valuable tech companies out of India, till that happens, venture funds will have to manage to do some of these hardcore tech ideas and some more, let's call them non-tech high growth ideas. And they'll marry this and carry on till we start finding enough of those high growth tech ideas. And that could be an interim 10-15 year period from now to then. So what happened in China between 2005 or 2000 to 2010 in the venture market, we're probably going through something like that right now. And suddenly we saw a huge takeoff in tech ideas in China in 2010 to 2018 or so. We can't exactly predict when that will come, but it's some give or take 10 years away. So in the medium term, and think of medium term as 10 years, we think some of this behavior will continue till we move completely towards tech-led ideas for the venture firms.
While Abhay sees this as a medium-term pause, our next guest, Anand Lunia from early stage fund India Quotient, thinks it's more temporary in nature. As an early stage investor, he has a close view of how the reset is affecting founders. I started by asking him if investment in traditional ventures a safer bet for investors.
So I wouldn't say that going into a non-tech offline business is safer. It's not. It gives you an illusion of safety for maybe 5-7 years versus a 2-3 year mortality in a social media company, for example. Similarly, Going into enterprise SaaS, gives you maybe 5 years of run before you actually face the reality of not having a market, versus going into consumer SaaS, which is risky, and you might face results in maybe 2 years. I think a lot of what happened in the last year in India, the VCs and founders were not chasing innovation. Many founders and unfortunately many VCs also were chasing the money that was being printed in US. So our ecosystem sort of catered to that demand, where the world was looking for GMV growth businesses, and Indian founders and VCs provided the world the GMV growth businesses.
Yeah.
Now that money printing is over, and there is no market for those kind of GMV businesses, right? And now we are seeing what's happening to payment companies. We are seeing what's happening to some of the e-commerce ideas or credit card ideas, etc. And I think we are back to the industry is going through saying, okay, while we take a pause and see what kind of money flow will come from overseas, in that interim period, people are saying, okay, maybe we do a little bit of more conservative businesses. So it's a
Okay.
tactical pause, I'd say. It's not like a permanent shift saying, okay, now we'll stop doing anything
Yeah.
bold.
So, how is this conservative environment impacting the types of startups that are being founded? And then, if you can talk about your own, personal investment thesis, like how are you investing right now?
Founders, like I said, founders are catering to a demand. So there are two kinds of founders in India: founders who follow the passion and love of their life, founders who say, oh, I've been dreaming about this company for last 5 years, this is the only business I will do, and I want to do it because it's a bold, game changing, innovative attempt. And then there are founders who come from elite colleges, founders who come from consulting background or banking background, who say there is a lot of VC money being available. It's an alternative career for me, and I should do a VC funded business because it's more convenient to do a VC funded business or fundable business. So half of the founders in the country are solving for fundability before they even jump in. Right? So they'll go to their friends who are VCs and ask around, will you fund this business? Depending on what the feedback is, they'll eventually converge to a safer business. So you see a lot of people coming out of companies like Flipkart or Udan or many others today and starting retail businesses. Why? Because they feel that online retail, etc., is tough. Money flow is stopped there. Maybe there is more money in offline retail. And a lot of founders are solving for the funding first and innovation later because they don't see it as doing a startup, but they see it as an alternative career. Nothing wrong about it. Again, there are so many gaps in the country. We need all kinds of founders. Naturally, people people will sense, founders will sense that, okay, if I start and jump in, leave my job, do this, what are the chances of me getting funded? Chances of getting funded in a very bold company today are less than they were like 4 years ago.
Can you talk about any deals that you've closed in the last 1.5 years?
All of us started investing in AI driven applications even before ChatGPT was launched, right?
Okay.
And some business cases were sort of killed by ChatGPT. But many of our other companies are now saying, okay, we can't, it's tough to build a ChatGPT like core model out of India, but can we do the picks and shovels business? Can we do LLM implementation from India, etc.? There's a company which is doing what Roblox did for US teenagers. There's a company which is trying to build offline version of Instagram. There's a company which is trying to build a digital marketplace for
Okay.
buying digital experiences like Urban Clap, but for digital experiences. So we feel that there are a lot of these opportunities which are purely digital, very innovative, very different. So we're getting companies in all of these areas, and we haven't had to play safe. I'd say a fund has to take a call saying, this is a strategy. We want 100x returns, we want 50x returns, and we're going to stick to that thesis, come what may. The day I say, okay, I want to do a few safer companies, I'll probably have to alter the entire fund strategy. I can't do it like a mix of both.
So you're still thinking you're still betting with the mindset of getting a 50 to 100x return.
Apurva, the reality is, if I think I'll get, see, mortality is same. I have in
Yeah.
the past we made mistakes of thinking that, oh, this company looks safer. It might do just a 5-10x, but looks much safer. Never works out that way. All my peers have gone through that cycle. So you'd see safer bets maybe at a Series B, C stage by
Yeah.
some VC. But early stage, there is no such thing as safe bet. So you
Correct.
might as well
Yeah.
aim for 100x, right? I think everybody knows that math.
Yeah.
Uh, I think we'll have to just let this one cycle, Apurva. I know we had COVID. We have some funds have had struggle with exits. We have struggled
Yeah.
with some exits. And plus, there's so much of flux going on with Chat GPT, what it will do to some industries, what will it do to SaaS industry, etc. I think it'll cool down and we'll get back to maybe the industry will shrink a little bit. That's okay. That's possible. But after that, I think all of us have done very well chasing innovation. We'll get back to that very soon.
Finally, I spoke to Digvijay Mishra, who's the deputy editor of startups at ET. He helped me understand how this rethink is impacting deals and exit scenarios, and how the entry of more domestic capital is changing expectations from young startups. So, Digvijay, profitability, offline bets, corporate governance, are VCs becoming more like private equity firms now?
That is true. Like, that is what is happening, and it is becoming which is where you see private equity companies now coming in early in the kind of new age companies we are talking about, because they have started operating like the companies which a typical mid-market PE firm will come and back. And if you see, a lot of family offices are also investing. If you see, like SoftBank,
Yeah.
Tiger, they have gone slow throughout last year and still not much activity. A lot of that growth stage capital is coming from family offices, as we have kind of captured across many stories. Now they don't invest in businesses saying, "Yeah, I will, do this in 5 years." They want you to grow, but they also want to make money. There's very clear, like, this is not a family office, is not a VC model. And some of the family offices which operate in a different way, where it's in the Bombay language, is there a dhanda there? Like, do you have a real business
Yeah.
model there? That's what matters to them.
I want to talk to you about returns for a second. The whole venture model is, constructed on this idea that a few companies will deliver outsized returns, betting
Yeah.
on the outliers and such. But do you think that, or these offline bets that VCs are taking can deliver those outsized returns, or have VCs and LPs sort of come to terms with the fact that, some return is better than no return?
If you see the kind of new funds that are getting set up by former VC executives, they are all small, mid-sized funds, and they are the kind of bets they are going to take will be like, you come into a company, make it say 200, 300 million valuation, and then take it to IPO at a 500 million or 600 million valuation. And that's not a bad outcome at all, given where you're starting and where the capital, what valuation you're entering and what you're exiting to. That is a reality that has creeped in across different venture funds, and which is why you're seeing that these guys are okay, listen, I'm coming to a company at a 150 or even 100 million valuation. Can I take it to 900? Can I take it to a billion? And that should be good enough, because when while you're chasing crazy multiples, the risk is definitely has to be much higher. So there's a recalibration happening there again, which is where you're seeing that probably why these guys are going after companies like this, thinking, okay, we will not be like 80x, 90x kind of returns, but these will be safer bets. That is also going through a change. To give you an example, that the if executed well, there will be good possibility to match the kind of tech returns. The classic example is the Carrot Lane deal that has happened, which is actually creating a lot of buzz for all the other jewelry companies, and especially Bluestone's ongoing funding round and IPO plans. That if you build the company in the right manner, in a sustainable manner, and you build the right branding, and given the founder exit for Carrot Lane happened at 17,000 crore valuation, there is a lot of potential for
Yeah.
Bluestone. But again, Bluestone, from it started, and I don't know where they will finally list it at. But if they manage to do a 14,000, 15,000 crore valuation, or anywhere say around 2 billion, that's a very good outcome. The idea that these guys are going with is that, while we still want to be tech first, let me hedge my bets with some of these other
Yeah.
companies.
I just wanted to, look back at the last 2 years in the venture capital space. We saw Sequoia brand leaving India. Then Alpha, there was a story that Alpha Wave is going to do more traditional investment. There was a, consolidation sort of last week when Venture Highway and General Catalyst sort of
Yeah.
merged. And then there have been a lot of exits of, top partners from venture funds as well. I mean, are these all like unrelated events that are just happening in a cycle that we're going through? Or is there a meaning behind all of this, and is it related in any way?
Both yes and no. Sequoia split, what happened, has very, very, very different reasons. Uh, but of course, it shows that there is a certain view on the India market. We don't know whether Sequoia on its own will come and invest here or not. There are all sorts of rumors that we've been hearing since the split happened. But I don't think India in fact, the more I talk to people, the more the sense I get is, it is a bright spot compared to a lot of other emerging markets or big markets outside the US, which is why you see someone like something like the Venture Highway deal happening, because General Catalyst has been doing some early stage deals,
Yeah.
but they said they have plans to have someone on the ground, but it didn't really work out. There were some executives who will fly down and then just spend some months. That's not how it works. You have to have people here and have a connect and source deals, do diligence, help them early on. All those things are needed. So in that context, I would say General Catalyst deal shows that how they want to do more in India.
The sun did finally shine on the Indian startup ecosystem last week when Zepto, a quick commerce startup, raised a round at over $3 billion valuation. This year has also seen IPOs like Ixigo and GoDigit, with several others like FirstCry and Swiggy on the horizon. In terms of exits, PE and VC exits in India surged 36% last year to almost $25 billion, up from $18.3 billion in the previous year, according to industry data. But the long slowdown has really affected venture firms, which are driven by fear of missing out. My colleague Samita Sharma wrote in a recent op-ed that the solution might be to develop a unique India VC model, different from what's worked in the last decade. But every time there's hope for change, a new wave of funding blitz pulls the industry right back into its old ways. Hopefully, this time might be different, a cliche VCs so often use themselves. That's all for today. I'm your host Apurva Mittal, and you were listening to the Morning Brief from the Economic Times. This episode was produced by Vinay Joshi. Our sound editor is Amrit Redji. Executive producers are Anirban Chaudhary and Arijit Burman. The Morning Brief drops every Tuesday, Wednesday, Thursday and Friday. Do tune in to ET Play for all audio content, including the Morning Brief. You can listen to our podcast on all major streaming platforms. Thank you for listening in and have a great weekend ahead.